Right into it. All right, I'm going to compare a 1031 exchange versus a lazy 1031 exchange. Quick disclaimer, this is not a solicitation for funds, tax advice, or legal advice, but I will explain how we've helped people release their equity from properties they own and turn it into more of a passive investment for them while deferring or writing off all the capital gains tax. And I'll explain the difference between the lazy 1031 and the standard 1031 here in this presentation. We do record this as well, so we'll send out the recording to everyone who signed up tomorrow. So here's a little more information about People's Capital Group. Seth Martinez and I started our company in 2013 to help people build and preserve their wealth through passive real estate investments, strictly located in northern New Jersey, generally within an hour commute to Manhattan, by repositioning vintage multifamily housing. So what that means is taking a mismanaged apartment building that's generally outdated, rents below market value, a lack of amenities to the tenants, and buying that property and improving it with capital X improvements, making the units more up to date and more desirable, implementing amenities in the property, maybe laundry in the basement or storage or a dog walking area outside or a jungle gym or barbecue area, and making them more desirable places to live. Also, renovating the units and giving them the finishings that tenants are looking for, like quartz countertops and nice kitchens and bathrooms and remodeled apartments, recessed lighting, and so on. And by improving those assets, we make them more desirable to tenants. We increase the efficiencies in the building, ideally lowering our expenses, increasing our revenue streams and our rent roll, therefore increasing the net operating income. And then as we reposition that, we stabilize the asset, and then we'll generally refinance over a 3 to 5 year period, aiming to get back about 50 to 80% of our investors' capital tax deferred through refinance. And then sometimes we plan to sell, or at least our current offering, we plan to sell at the end of 5 years to create a final liquidity event and target IRRs between 18 to 20%. But this presentation is going to focus on how investors can free up equity in their buildings by selling those properties and 1031ing or doing a lazy 1031. We'll compare both strategies into passive real estate investment opportunities to create a more passive investment experience for them and also defer or write off that capital gains tax and ideally keep their money instead of giving it to the IRS. So here's the problem that many investors run into. Okay, so there's a number of issues here when looking to sell or own real estate. So of course, capital gains tax, right, being 25% or higher if it's a shorter hold, but generally capital gains tax about 25% of your profit, and that's a big chunk of change. If you think about it, if you sell a property and you're expected to get $1 million in profit out of that property, and if you've owned a small commercial piece of real estate over the last 5 or 10 years, it's probably a very reasonable scenario. Then you would expect to pay about 25% capital gains tax. Now, that really limits your purchasing power when you go to reinvest that money. If you want to buy another property with $1 million, you can ideally buy, say, a $3 million asset. With a tax burden of 25%, if you end up not doing a 1031 or a lazy 1031, you're looking at $750,000 coming out of that, right? And 1 million times 0.75 or minus 25%. And that 750,000 will allow you to buy, say, a $2.1 million asset or so. So right there, by avoiding capital gains tax, deferring capital gains tax, you're able to invest in a larger piece of real estate by $1 million almost. So solving the tax problem is huge to building and preserving your wealth. Secondly, real estate's management intensive. So what we aim to do with our investors and our clients is create a completely passive real estate investment experience with monthly updates, quarterly financials, K-1 tax forms done for them, and an investor portal where they can log on to and get this information anytime. And also review past performance and upcoming investment opportunities. So it's a truly passive experience for investors where generally owning a piece of real estate, you're on the hook for either managing the management company or managing the tenants yourself, which can be a very frustrating experience. If any landlords are here on the masterclass here, you do know how frustrating it can be when you have enough units and enough tenants that always seem to have problems on Christmas Eve at 2 in the morning or something like that. And also locked up equity, right? When you own real estate, it's notoriously illiquid. That means you may have wealth, but it could be locked up in real estate ownership. And the only way to access that wealth and reinvest it to make more returns or even pocket some of it as well is to sell the asset. And when you sell the asset, of course, as I mentioned here, you have capital gains tax. So the whole point of this presentation is to understand two options to complete a regular 1031 or a lazy 1031, and then ideally refinance that new purchase, that new asset you're trading into, to release some of that capital and turn that equity in your real estate into tax deferred or tax free cash in your pocket. And that's what we all like, of course. And costs. So there are legal costs, the agreements. We'll talk about the tenants in common, a TIC, a document that we use for 1031 exchanges into assets with us, and other costs when doing a 1031. So we also try to keep those costs extremely low and essentially just work them into the deal so that the investor can save money on costs by relationships we have with attorneys and 1031 intermediaries and so on, whether you're completing a standard 1031 or a lazy 1031. And the process. So we'll go over the difference between a standard 1031 and a lazy 1031 in this presentation, but it can be confusing, create anxiety. You want to work with an experienced team that knows how to do this and has the right professionals in place that can help you sell, transfer, and reinvest that wealth into a excellent investment opportunity and make it seamless and quick. So here's two solutions. Okay, so we'll break down both of these options here. The 1031 exchange, of course, that's a standard 1031 where you sell your property, you move the proceeds into a 1031 intermediary, and you reinvest ideally into a passive opportunity with people's capital group where you can enjoy quarterly financials and cash flow distributions, monthly updates, and large liquidity events upon refinance or sale. Now, there are some caveats that come with that we'll break into in the next few slides. Or a lazy 1031. Now, this is a new term to many people. It was a new term to me earlier in this year. I've been learning more about it, and it's an interesting strategy where you sell your property and you reinvest in the same year into a new opportunity. With that new investment opportunity, you'd front load the tax depreciation through a cost segregation study, which I'll explain more about. Essentially, it's a third-party study that allows you to accelerate your tax depreciation and take a lot more tax depreciation in the year of purchase. And so as you reinvest into that new investment opportunity, you front load the tax depreciation and you essentially use that accelerated tax depreciation in the new investment to write off the capital gains tax burden from the previous investment. And if it's done in the same calendar year, you can write off your capital gains tax burden through that accelerated tax depreciation in that new investment. You can write off the capital gains tax burden from your previous sale. So that's called a lazy 1031. You're not doing a traditional 1031 with a third-party intermediary, with the TIC requirements and so on, the 45-day limit, the 180-day limit that we'll get into. It's a little bit easier, but there's also some negatives to it as well. So we'll break down the pros and cons of each option. Okay, so let's get into the process here of exactly how this is done. So a lazy 1031 process. All right, so the first goal, of course, is to sell the piece of real estate you own, ideally for top dollar, and reinvest in the same calendar year. Okay, so right now, for example, we are purchasing a 42-unit apartment building in Passaic, New Jersey. Rents are far below market value. We expect about a 19% internal rate of return to investors. So let's say someone had sold their property and they have $1 million from the sale of that asset. Well, if they decide to do a lazy 1031, they could reinvest that $1 million into this opportunity as a passive investor, and they can then front load the tax depreciation on this opportunity, as long as it's done in the same calendar year, to write off the gains from that previous sale. So sell your property and reinvest in another property in the same year. With that new property, we do a cost segregation study. It's a third-party study that allows us to front-load tax depreciation or accelerate your tax depreciation on the new acquisition. And investors would expect to receive a depreciation in the amount equal to about 30% of their investment. So on $1 million investment, you'd expect about $300,000 in tax depreciation. Now, as long as this is done in the same calendar year, the sale of the asset and the reinvestment into the new asset, you can use that tax depreciation that's front loaded on the new investment to write off the capital gains tax of the previous investment, previous sale. Now, here's one of the challenges, though, with a lazy 1031. Let's say the property you owned, you were actively managing, okay, or you were managing the management company. You were signing for the mortgage. You worked with a realtor to find it. You were the active owner of that property. Even if you had a management company in place, you still are the active owner of that asset. You're managing the management company. You're signing for the debt. You're the active owner, right? When you go to invest in an opportunity with us here at People's Capital Group, you become a passive investment. You become a limited partner. You don't sign the mortgage. You have nothing to do with the debt. You don't have to get qualified for the bank or anything like that. You don't manage the asset day in and day out. We take care of all of that. And in full transparency, we send monthly updates, quarterly financials, quarterly cash flow distributions when available, deposited right to our investors' accounts, and annual K-1 tax returns. So the challenge is when you're moving from an active investment into a passive investment, you can't use passive tax write-offs to write off an active gain. So what we like to do with our investors is we keep a timesheet on the new investment and we ask for their guidance on certain things or consulting on certain management challenges with the property. They could review leases, they could participate in strategy, and we want to keep a timesheet that shows that they are participating in some way or another, a certain amount of hours through the year that allows them to be considered an active investor in that new investment. Now, as an investor, you'll still own LP shares, limited partner. You won't have to sign for the mortgage or actually manage the asset day in and day out. But as long as a timesheet is kept that shows active participation in that new investment, you can then ideally create, you can call that tax depreciation you're creating from the passive investment, you can call that active tax depreciation. Now, of course, you want to talk to your CPA whenever you're doing a lazy 1031 or any type of transaction that involves tax guidance. Now, it's a lot simpler if you're transacting out of an LP position, a limited partner position, 100% passive investment, and you're doing a new investment into another limited partner position, another passive investment. Then there's no timesheet required to show you as an active partner on that new investment. The only time you have to keep that timesheet is if you're trading from a property where you are the active landlord and now you're moving into a passive position on that new investment. So you want to make sure that timesheet is kept, and PCG can help you with that to show active participation in some way or another in that new investment opportunity. So therefore, the tax depreciation you receive on the new investment opportunity can be considered active to write off your active gain from your previous investment. So that's one of the challenges you have with a lazy 1031, that active or passive tax bucket, but that is a way to solve that problem with that timesheet showing active participation. Of course, it is much simpler if you're trading out of an LP position into another LP position. Then, of course, you have passive tax gains you can write off with passive tax depreciation. Okay, now here's the standard 1031 exchange process. So first, you sell your property. You place the funds into an intermediary. Now, it's very important, by the way, that if you are selling a property, you get in touch with a 1031 intermediary, the operator you want to reinvest into prior to selling, right? Whatever you do, don't call up your 1031 intermediary after the sale or even a day before the sale or anything like that. In fact, you should be talking to whomever you want to reinvest with and whoever you're going to use for the 1031 intermediary. By the way, we know very good 1031 intermediary. So if you are seeking one, we can guide you in that. Um, and you want to make sure you're in touch with this intermediary and the next operator you're going to invest in prior to this sale, really prior to even getting it under contract, right? Because it takes up some lining up from all parties to make sure this is done properly, whether you're doing a lazy 1031 or a standard 1031, but especially if you're doing a standard 1031. So the strategy with a standard 1031 is, of course, you sell the property, you place the funds in an intermediary third-party service. You identify 3 like-kind properties in 45 days, and then you have to close on them within 180 days of your initial transaction. Now, if you're working with a good operator, like People's Capital Group here, we'll present you a property to invest in, and we'll go over the details of how you can do a standard 1031 into our investment opportunities. It's a little more of a delicate process, but it can be accomplished. Now, a couple more things on the sale there of the property and the trading into the next property. You also have to invest in a like-kind property. So what does that mean? Well, if you're selling a $3 million property, you have to invest in a total of at least $3 million of new real estate investments. That's one of the rules of a standard 1031 exchange. That makes it a little more complicated than a lazy 1031. Another rule, aside from the time limit there, is that you also that with trading into another property, you have to have a TIC in place, a tenants in common, which we'll go into in the next slide. And the debt. The debt's a very important thing. If you're selling a property where you have, say, a 60% loan to value, okay, so on a $1 million property, you have a $600,000 mortgage, you have to trade into a property where you have a minimum of 60% on the next asset. Okay, you cannot trade into a property where you have 50% mortgage amount or 0% mortgage amount. I mean, you can, but it's gonna create some type of tax burden. So your 1031 intermediary will guide you in this, but there's certain rules and regulations that can make a 1031 somewhat restrictive and limits the type of investment you can go into. Now, when we are working with 1031 investors, the first thing we need to know is, how much capital are you going to have from the sale? What's your mortgage amount on the current asset, right? And what's the timeline, all right? So all these questions can be figured out pretty quickly in advance, and then we can line up the proper investment for your investment goals, granted that it's a fit for your parties and ours. The next step is to buy an asset, right? So at that point now you want to review the TIC agreement. This is called a tenants in common. You can also 1031 into a Delaware statutory trust. Those tend to be larger funds, generally 50 million or greater, but those are options as well. I know there's like 1031.com and different services that work with Delaware statutory trusts and other publicly traded REITs that work with Delaware statutory trusts to allow you to trade into. In our case, we're identifying a specific property that generally 1 or 2 investors are going to do a 1031 into. For example, we're buying 12 condos in Long Branch, New Jersey right now. We're having one investor complete a 1031 tax exchange. He's selling a hotel for $3 million and trading into a 12 condo package with us that we're buying around $3 million. And is exiting a property where you had about 60% debt. We're taking on about 60% debt with a new opportunity. So it lines up very nicely. This investor will move $1.5 million into the opportunity, which is the full amount of equity required. And we're creating a TIC agreement, a tenants in common, that allows him to own 75% of the asset. We'll own 25% of the asset. And this TIC agreement, it means that it allows him to 1031 into the opportunity, but it also requires him to be an active owner. Now, that means the bank will need to underwrite this investor. The investor will need to complete certain bank docs. We'll set up a non-recourse loan, so there won't be a personal guarantee required, but there's still a bit of a pain in the neck when trading into an opportunity through a TIC, through a standard 1031 exchange process. So it's not as passive as a lazy 1031. That's one of the main benefits of a lazy 1031. However, the experience once purchased is quite passive in that there's monthly updates, quarterly financials, quarterly cash flow distributions, annual K1s done for the investor. So the experience, once owned, is quite passive for the investor, but they're technically an active voting member. They can vote on major decisions such as sale, refinance, even leasing is required to vote, which is pretty much easily done by an email and email back of approval. So we try to make it as easy as possible for our standard 1031 investors when investing into a TIC with us. But we complete the bank process, we transfer the funds into the new investment opportunity, and then generally the goal with a TIC or an investment opportunity like this is to refinance very quickly. Really, in 13 to 37 months, we aim to refinance that asset and get anywhere from 40 to 80% of the investor's capital back to them. Now, what's incredible about doing a 1031 exchange into a real estate investment opportunity and then doing a refinance within 1 or 2 years is that you're essentially taking that cash back out of the property, putting it in your pocket, but it's all tax deferred. So when you refinance an asset, it's not a taxable liquidity event. What happens when you refinance an asset is you're taking on debt. And you want to take on a smart amount of debt. The bank's not going to give you more debt than the property can handle, can pay down based on its DSCR, debt service coverage ratio. However, when you're refinancing an asset, you're able to harvest that equity growth. And for example, when we're buying these 12 condos with this 1031 investor, we're doing a refinance at month 13. That's the target. He'll expect about 40% of investment capital back. So on a $1.5 million investment, that's about $600,000 back into his pocket, tax deferred within 13 months. Where normally, if you just sold a property and pocketed the cash, you'd have capital gains tax, taking out 25% of that. In this case, this investor can get back 40% of his investment in 13 months, tax deferred. So that's a major benefit of doing a 1031 and then doing a refinance right away, which is what we like to try to structure. Well, not right away, but within a year to 2 years for our investors. We try to structure that to give them a tax deferred liquidity event. Okay, let's go into the pros and cons of a standard 1031 exchange. So one of the pros, the benefits of a standard 1031 is that you get to keep your tax depreciation, right? With a lazy 1031, you're utilizing your tax depreciation to write off that capital gains tax. In this case, you not only get to defer taxes with a standard 1031, but you also get to get a large tax write-off when you buy the property. You get even more tax depreciation. Another benefit is you could do it in a different year. Now, there are limitations, like I explained in the last slide. You have to identify a property within 45 days. You have 180 days to trade into that asset. Like-kind exchange is required. There's debt requirements. There's also a TIC requirements and so on. So there's some negatives there, but you can do it in a different year. If you sold a property right now, you could 1031 in next year, as long as it's within that 45-day period to identify the asset and 180-day period to close on the asset. In fact, that's exactly what we're doing with this investor. He closed in December. We'll be closing on this 12 condo package in February, which will line up, which will be in line with that 180-day requirement. Another one negative here is the time period. As I touched on, you're limited to 45 days from the date of sale to identify 3 like-kind properties and 180 days from the day of sale to trade into them. Another negative is the TIC. The tenants in common, as I was explaining. This requirement requires investors to sign for the mortgage. Again, we'll structure a debt that it doesn't require personal guarantee, but still being underwritten by the lender is a pain in the neck. Voting rights for other investors can force a sale. So if we have 2 or 3 investors in on a TIC, we all have to make sure we're on the same page and we all get along, because if you have an investor that wants to force a sale, technically that could be done with a TIC. That's why we try to do TICs with 1, at most 2 investors, so there's not too many cooks in the kitchen, as they say. Also, voting on new leases, which we try to make as seamless as possible. We'll email you the new lease and say, this is the best tenant, the best application. Just respond to the email with approval. And voting on major events such as sale or refinance. So it makes the investment experience slightly less passive than a lazy 1031. All right, so the pros and cons of a lazy 1031 are that there's no time restrictions in identifying the property and closing as long as it's done in the same calendar year. But technically, you could sell a property in January, create that capital gains tax burden, and then buy a property or reinvest in a property by December, and you'd still be, as long as it's in the same calendar year, you can do that lazy 1031 exchange by using that tax depreciation from the new investment to write off the gains of the past investment. The negative is your tax depreciation is pretty much exhausted on writing off the capital gains tax from the previous sale. Now, what we do find is that the cash flow on North Jersey real estate is not where the main profit center is for our investors. Most of our opportunities earn about 2% cash flow the first year, about 4% the second year as we're repositioning the asset, and about 8% by year three. In the beginning of year four, we're doing a refinance to achieve about an 80% return of capital at the refinance. That's our target for our current investment opportunity. And then we sell around year five. So the cash flow, even if you exhaust your tax depreciation on writing off the capital gains tax, the cash flow is still very light. So the tax burden would be pretty minimal. So it's still a much better tax bill than you would have from any type of capital gains tax on a sale of an asset if you're not doing lazy 1031. But if you're investing in an asset that has strong cash flow, like 10% a year or something, then you may want to recognize that's a negative there. Maybe a lazy 1031 is not the right strategy for you. A positive is there's no tick required. So the investment experience is truly passive. There's no need to engage with the lender, approve leases or sale or refinance, and that can be much more desirable to investors. The negative is if capital gains tax from an active investment, as I was explaining earlier, then a timesheet must be kept to show active engagement in the new investment. That way you can call the tax depreciation from the new investment an active, it can go to the active bucket for as an active tax write-off or active tax depreciation to write off your gain from your active previous investment. So here's the core team at People's Capital Group. That's me on the left, Aaron Fregnito. I started in real estate around 2010. Seth and I have done over 300 transactions together in New Jersey. I primarily focus on working with our clients. I do podcasts every single month. We have about 170 podcast episodes called the Passive Cash Flow Podcast. I do educational webinars every single month as well. These topics range from real estate investment strategies like this, tax strategies, retirement strategies as well, IRA, 401k based pieces of information, and then also local New Jersey market master classes also. So I do a masterclass every single month, generally in the last week of the month on a Wednesday or Thursday afternoon. If you're on our email list, you'll get those sent out to you. And if you can't make the webinar, sign up for them. We'll send you the recording. I actually wrote and taught a course called Real Estate Entrepreneurship at Rowan University also, and I speak in the tri-state area, actually all around the country, about real estate investments to different real estate networking groups. And I'm primarily out there working with clients, raising capital for our next funds and so on, and focused on the marketing and branding of the company. Seth Martinez has over 20 years of entrepreneurship experience in real estate and healthcare. He's primarily in charge of managing the management company, operations here, People's Capital Group, running our debt fund as well. Together, we have about $40 million in AUM. We've done over 300 real estate transactions. Lena Delgado runs our property management company. She is hardworking and incredible in what she does. She has a decade of property management experience. She ensures our tenants have a high quality experience. A happy tenant equals a happy investor. And oversees PCG Property Management, which is our in-house property management company. She manages the staff there and our independent contractors. Dana Sargenti, our expert bookkeeper, over 35 years of bookkeeping experience. Daily responsibilities include bookkeeping, paying invoices, reconciling accounts, preparing quarterly financials, and making sure our investors get paid in a timely manner on those quarterly distributions. We work with a lot of experienced professionals. We have virtual assistants that help with the administration of our property management. We work with tax specialists and 1031 intermediaries. If you need a good intermediary for your 1031, let us know. We work with a great CPA firm for over the last 10 years. that provides tax planning and strategy and tax filing for our company and our clients. We work with attorneys of all different shapes and sizes for real estate closings, drafting the private placement memorandums, drafting the TIC agreements, the tenants in common agreements, to allow for 1031 into opportunities with us. Also, landlord tenant court for evictions and so on. We also do expert due diligence. We work with really great underwriters. These are underwriters that have experience with Fortune 500 companies, underwriting institutional level opportunities. So if you've ever seen our spreadsheets, and if you haven't, email us. You can email me at Aaron at peoplescapitalgroup.com. You can set up a call with me. It's in the chat. You can see our models, our Excel models for underwriting is extremely in depth. We have great banking relationships, realtors, broker dealers, other real estate specialists to ensure our investments are properly underwritten, and we cherry pick the best opportunities. We'll look at 400 deals to close on one. And we try to make that a nice passive experience for our investors so that they can look at our due diligence and fully understand the investment opportunity, determine if it's a good fit for their investment goals. We work with a lot of independent contractors. We generally have about 4 to 8 crews working at any given time. We work with very good leasing agents to make sure our units are leased up for fair market value after we renovate them and reposition the assets, our multifamily properties throughout northern New Jersey, with high levels of screening and qualifications for each tenant to avoid problems down the road. Great content specialist. We have over 160 podcast episodes, hundreds of educational videos, dozens of webinars and master classes and ebooks. It's all peoplescapitalgroup.com. You can check out all of our educational content. It's all free. We also have IT professionals. So we have a portal for investors to log in on. So if you're an investor at People's Capital Group, you can log into your investor account. You can see your monthly updates there, which are also emailed to our investors, and quarterly financials also emailed. Understand all the distributions you've earned on your investment, past performance, upcoming investment opportunities, and just get a nice dashboard of your real estate investments here. Also, your K1 tax returns are uploaded to your investor account. So it's kind of like having a passive stock portfolio and logging on to TD Ameritrade or something like that. But instead of owning stocks, you own real estate. So try to make it a very passive and transparent investment experience when investing with us here at People's Capital Group. Whether you're doing a 1031 into a TIC with us, a lazy 1031 into an LP investment opportunity, the experience is always similar, transparent and passive. So right now we're buying a 42-unit apartment building in Passaic, New Jersey. This is open to accredited investors only. We're actually planning on closing Monday. We are talking about a 19% internal rate of return, about a 1.9x equity multiple. So what that means, on a $100,000 investment, you'd expect to walk away with about $190,000 over a 5-year period. This is a classic Class C building we can reposition into a Class B asset with rents about 30% below market value. And the minimum investment on this property is $50,000. This is a 5-year investment horizon on that. Now, this building, it's too late to do a standard 1031 into this opportunity. However, it could accept lazy 1031 capital. But here's the catch. Of course, as I explained in this presentation, lazy 1031, for it to work, has to be done the same calendar year that we're closing on the asset. Now, I understand it is late December. So that means if you do have capital from the sale of an asset, you would have to complete the investment by the end of December, which doesn't give much time. That's why I put a link in the chat to schedule a call with me, which you'd want to do as soon as possible if you felt like this was a fit for your investment goals, or if you just wanted to learn more about our investment process. We have an upside of 30% on the rents. This is a desirable location within a 55-minute commute to New York City, right near a big bus terminal, and downtown Passaic as well, which is having a renaissance at this time. It's off-market acquisition. We were the only bidder on this property. We snagged it before it hit the market. We know the realtor, and that's how we buy great deals for discounted prices. Classic mismanaged building, low rents, no amenities, trash in the backyard, outdated units. Right up our alley is a Class C building in a strong location that we can reposition into a Class B asset over about a 3-year period to get to a large refinance for our investors and eventual sale. We do expect cash flow from quarter one. Now, that's not where investors make the majority of their return with our investments. As you can see here on the right, we expect about 2% cash flow in year one, about 4% cash flow in year two, 8 to 9% cash flow by year three as we stabilize the asset. And we plan to do a refinance beginning of year four, where investors would expect about an 80% or so return of their investment capital, plus additional cash flow, and in a sale about year five, into year five, about month 60, where they would experience the majority of their profits are realized on the sale of that asset. Now, to avoid capital gains tax on that profit, right? So if you invest $100,000 and you walk away with $190,000, you just paid $90,000 in profit. What we do with our investors is we'll offer another opportunity for them to invest in and essentially do a lazy 1031 into that next opportunity, which we'll plan to close on in the same calendar year. So that's exactly why I like teaching these strategies, because we implement these strategies for our investors, and we always think about our investors' tax bill and their total net return, right? It's not what you make, it's what you keep. And it's important when we're guiding our investors to make sure we don't leave them with a large tax burden. So in this case, our strategy is to probably have another asset, not do a technical 1031, because that leaves limitations for how investors can exit, but do an actual sale of the asset, and then the same calendar year, buy another asset. And those investors can roll those proceeds into that next opportunity, take a large tax depreciation on that new investment, and write off their gains from the previous investment, as long as we do it in the same calendar year. So what we'll offer this is a lazy 1031 on this exact investment 5 years from now as we exit the asset. Another benefit of this investment is we target about 80% of the investment to be returned to month 37 on the refinance. That's a great amount of capital to be returned on a refinance within just over 3 years. Again, that's a tax deferred repayment of capital. So that's a really nice large check on a $100,000 investment. You expect $80,000 back on that refinance around month 37. So right now we have 75% of the capital raised for this asset. We are ready to close. We have all the capital to close and start renovations, but we do have room for about 25% of the capital to be invested at this time. We have other family offices and large investors that can come in to complete that amount, but we like bringing in new investors. We like building new relationships. We also want to leave room for people to do a lazy 1031 and write off their tax burden in 2024. So if you have a tax burden from 2024, this opportunity can allow you to write that off. And we want to set up a call, though, very soon, because the time is limited on how long you have to do this. Of course, the investment has to be completed by December 31st of 2024. So we'd have to talk in the next couple of days to make sure this is a fit for your investment goals and get the process started and getting approved as an accredited investor. And you do have to be accredited for this opportunity. That means an individual who makes $200,000 individually, or $300,000 including their spouse, household income, or has $1 million net worth, not including their primary residence. Okay, that's an accredited investor. If you feel that you're an accredited investor and you have a tax burden in 2024, then let's talk, because even if this isn't a fit for you, even if the timeline is too tight, it's important to understand this process, but also what we have coming up on the horizon in 2025. We do expect a 30% tax write-off in year 2024 and cash flow from Q1. We are going to fill up this offering by the end of the year here. We have some investors on standby, so really limited time opportunity. You'd want to schedule that call with a team member of ours really today or tomorrow to get that process in motion, to see if this is a fit for your investment goals, see if you do qualify as an accredited investor. Even if you don't have sale proceeds of just a regular cash investment, it's still important to get invested by 2024 to get that big tax write-off that we front load in 2024. So that's it for me, ladies and gentlemen. I'm Aaron Fragnito, the People's Capital Group. I'll check for any questions here in the Q&A or the chat. But I put the link to schedule a call with me in the chat so we can discuss your investment goals and see if this is a fit for you. If not, we try to buy about 2 apartment buildings a year. So perhaps we'll have something in 2025 that is a fit for your investment goals. Or if you have liquidity events expected in 25, then we definitely want to talk sooner than later. Even if you have a property you're thinking about selling, it's important we talk before you put the property on the market so we understand your investment goals. Is it better for you to do a regular 1031 or a lazy 1031? And how can we help you with that strategy and that experience? So let's take a look here.